Assalamu alaikum. To accommodate all the time differences around the world and people who are participating, good morning, afternoon, or evening. My name is Abdulillah Darandari. I am the coordinator of Task Force 1 and the senior researcher at CAPSARC. Thank you to each one of you for being here with us today. We're very pleased to welcome you all. Today marks our first Task Force 1 webinar, and we are proud to be able to host this and continue to collaborate in these troubled times. It is wonderful to be with you all. Before we get started, I would like to express my sincere appreciation to all the panelists and participants coming together and discussing dynamic topics related to the implications of COVID-19 pandemic on trade, investment, and growth. We have a broad range of experts that will discuss these topics in detail. COVID-19 has no doubt disrupted the functions of households, the ability of firms to stay afloat, and governments to react. As policymakers weigh the balance of public health and economic downturns, it has become apparent that it is no easy task, and the consequences can be large. Trade and investments have slowed down, economic growth becomes the victim, and because of COVID-19 and containment measures, as countries seek solutions, a lot of speculation are rising, particularly regarding globalization, protectionism, trade rules, and agreements. This webinar aims to discuss most of these issues caused by COVID-19 and its containment measures. To keep the panel discussion smooth, we kindly ask you to keep questions at the end of the panel discussions, as sometimes your questions are answered later on. Type your questions in the Q&A tab, and I will address it for you. Without further ado, please join me to welcome Dr. Fahd Al-Turki, the chair of the T20 and vice president of CAPSARC.
Thank you, Abdulillah, and welcome everybody. It's a pleasure to connect with you today. This marks our 7th webinar in a series of trying to understand what the implications of COVID-19 on the priorities of the task forces. And it is also the last webinar before our Eid break. For our international partners, today is the last working day for in Saudi and probably many other organizations within the region. Next week will be the Eid holiday. So Eid Mubarak to everybody. And a special thanks to the lead co-chair of this task force, Dr. Saeed Al-Sheikh, and the coordinator, as well as the rest of the co-chairs of this task force for coordinating this webinar in a very short notice, as well as in a critical time, both at the end of the working days in Saudi, as well as we cope up with the implication of COVID-19. First, I would like to emphasize that the reason why we started this series of webinars is just to understand how the implications of this human tragedy, in fact, impacting our lives. And if I may say, this is the most significant civilizational threat that we have seen in our lifetime. And by now, COVID-19 has spread to more than 4 million people in over 180 countries, a rate of infection that we have never seen in more than a century. Such high spread rate of the virus have a major impact on our social lives, healthcare system, as well as the economy and markets. On the whole, on the health side, even strong and well-funded healthcare systems are struggling to respond and to keep up with the rate of spread. Even with many countries introducing social distancing measures. Within the socio-economic impact, which is more or less the focus of this working group, the impact is very clear. Global economic growth is turning into a negative territory, and we've seen the IMF revising their forecast to a -3 this year. And they're looking into a massive growth next year of 5%, positive 5%, but I doubt that is likely to materialize, especially if we're looking at other implications of the pandemic, including the significant increase in unemployment, and there's some estimates it's likely to reach 25 million people unemployed, Many countries are experiencing a double-digit unemployment rate. SMEs are going out of business, and most of even large corporations are facing a lot of difficulties managing their cash flow. On the social side, inequalities are deepening, and we as a society are finding it very hard to meet the needs of the most vulnerable households, including the elderly and also the vulnerable citizens in many places. All in all, countries are, or policymakers within all countries that are facing two hard choices, and most of the time, or they are actually contradicting choices. If they don't act immediately and lock down, they will risk thousands of deaths related to because of COVID-19, and also at the same time risking the overwhelming their healthcare system. On the other hand, if they shut down the economy and introduce lockdown measures, then they would risk an economic collapse and meltdown with a high mortality from non-COVID-19 related reasons, especially in poorer places. So what most nations have done is, I think the second choice is to introduce lockdown and reduce the travel and also put number of restrictions on businesses and movements of people. But however, despite closing borders, virus knows no borders and all countries are being affected. And we were talking with the co-chairs just before we went live about the numbers here in Saudi and the numbers in Brazil as it's rising significantly. So this pandemic is really a harsh reminder that the world needs more multilateral collaboration and cooperation and global solidarity. And I think if we look at our history as a humanity, we should learn from previous crises, where global unity and solidarity is on top of our priorities during difficult times. And at the T20, we highlighted this in many statements, that there is an urgent need for investments in critical public services and global public goods to first suppress the virus and then also second, minimize the implications of the pandemic on our economy and society. And not only that, but also to recover better while maintaining our global connectivity and the effectiveness of our multilateral institutions in dealing with economic and implications of the pandemic. These measures need to be taken immediately to reduce the implications of this pandemic. And in light of this task force, when we discussed the priorities of this task force, I think we highlighted a number of parameters that we should focus on, including global trade imbalances and protectionism, attracting sustainable foreign direct investment, connectivity and energy efficiency in trade, a supportive, open, and inclusive trade and investment system, enhancing trade policies and agreements, bilateral and multilateral trade, confronting challenges faced by SMEs, and strengthening the WTO as a multilateral forum, and the free flow of data and digital trade. And these priorities are as important today as they are, if not more, compared to December when we decided the priorities for this task force. From our side at the T20 Secretariat, we issued the three T20 statements before and after the G20 Extraordinary Summit at the end of March. In these statements, we called for an immediate and coordinated stimulus package to allocate resources to workers, businesses, and households, especially in less developing countries. Some of the recommendations that are related to the work of this task force include scaling up cash transfer, social protection, tax reduction, low interest rate, access to credit, restoring global supply chain, reversing slowdown in global trade, improving access to medical supply, and insurance and wage support schemes, to name a few. As we observe in previous crises, and especially back in 2008 and 2009, financial crisis, government and monetary authorities must continue to stabilize the global financial market by continuing to inject much needed liquidity. And government also must partner with the private financial institutions to roll over debt to SMEs and individuals. Actions like this will minimize the implications of the pandemic on global economy. And it is events like this this webinar that is organized by the leadership of this task force brings us together as a think tank and highlight the contribution of the think tanks in contributing to the global economy in meeting pandemics such as what we're experiencing right now. And within the context of this task force, I would like to emphasize that such a crisis may play a constructive role in our ability to introduce reform and rebuild of multilateral institutions, including the WTO, to improve international cooperation and enhance the trade systems around the globe. So I would encourage you all to actively participate in this webinar and continue to contribute to our T20 mandate, which is providing unbiased research-based policy recommendations to the leaders of the world. And given the magnitude of this pandemic, which is the subject of this webinar, we need to go beyond even providing policy recommendations. If I may suggest going into providing initiatives or suggestions for initiatives for the leaders of the G20 to rebuild a better world and ensure healthy economic, social, and financial well-being for all. To conclude, I would like to say once again that the T20 and its partners are devoting their time and effort to help the world in facing the pandemic. And that an event like this will bring us together and encourage us to share our expertise. We look forward to working with all of you and with our partners across G20 and non-G20 countries to expedite the transition to recovery while maintaining the effectiveness of our multilateral system and international cooperation to ensure a sustainable and inclusive economic growth and investments. Thank you for your time, and back to you, Abdulillah.
Thank you, Dr. Fahad. We will begin now with our first panel discussion, moderated by the lead co-chair and senior consultant from the Riyadh Economic Forum, Dr. Saeed Al-Sheikh. Dr. Saeed.
Thank you, Abdulillah, and also I extend my thanks to Dr. Fahad Turki for his great remarks on the coronavirus and the implications on the economies of the world. Coronavirus continues to expand its global impacts on individual businesses, communities, and governments. The dynamic nature of this pandemic makes it hard to assess what will happen next. Despite the swift and comprehensive policy response by major economies in the world, such as US and EU and many others, including Saudi Arabia, global economy will experience a recession of historic proportion this year. To delve into the implications on the world economic growth, I'm glad and happy to introduce the first panelist, Yuri Dadush, who's the co-chair of this task force one, a senior fellow at the Policy Center for the New South non-resident scholar at Bruegel. Mr. Yuri, are you hearing me, Mr. Yuri?
Yes, yes, I can hear you.
Okay, I am introducing you and it's your turn.
Okay, thank you, Saeed. Thank you very much for organizing this. And let me begin by saying that I fully share all of the sentiments that Fahad Al-Turki has communicated from the start. I want to say that. I'm going to cover two topics, of course, very quickly. These are huge topics. I want to say a word about the pandemic and how it's affecting the economy. And then the second is, I will give you my views on the economic outlook. So on the pandemic, just very quickly on the pandemic, I really have to start there. Global cases are growing slowly. We don't see any more exponential growth at the global level, slow growth, while deaths are declining. Both of these numbers are undercounted, perhaps by 25–50% because of lack of testing, and especially so in developing countries. But still, the trends, I think, give a sense of what's going on. Unfortunately, several countries are still seeing exponential growth, as we said before: Brazil, India, Saudi Arabia, Qatar, other countries in Latin America. However, it's also true that most countries have, by and large, controlled the epidemic and are seeing sharply falling cases and sharply falling deaths. The other point that is critical for the economic outlook is that we now have a fairly good sense of the case fatality rate, which is deaths relative to the number of infections. And they are generally estimated now at being between 0.2% and 1%, which is much, much lower than originally feared. And the big range is depending on whether the medical system is overwhelmed. So if you look at Spain, it may be 1%. If you look at California or parts of California, even those that have had a real epidemic, it is more like 0.2%, which in some ways is reassuring. The other critical finding for the economy is that the likelihood of dying from coronavirus, if you're under 50, is close to zero, and it is low in the age range of 50 to 65. This means that the vast majority of the people at work, especially in the developing world, run a very low risk of deaths and indeed of severe complications from the coronavirus. That's a critical point. Also critical is that the older population, people like me, must be protected. Last but not least, we are seeing only slow progress on therapies. No real breakthrough so far, a little bit here and there, I won't go into it. But the development of vaccines is looking very promising and much faster than originally anticipated. Again, we don't know how this is going to work out, but certainly if you're thinking about the economic outlook for the next couple of years, you have to keep that high case scenario in your mind, that a vaccine may be available out of the 100 or so candidates sooner than many had expected. Perhaps by the end of this year. Even then, it will not be widely available, but it will nevertheless have a big effect on confidence and on policies. Okay, so that's the background on the disease. Now on the economic outlook. As you know, countries are opening essentially because people have to work. They have no choice. Most countries, the vast majority of countries that are opening and of states within the United States have the disease, in my view, under control for the time being. Some countries are opening earlier probably than they should. And certainly that is the case of some of the states within the United States, where cases are still rising quite rapidly. But by and large, countries and states are being forced to open. The opening is encouraged by the example of countries that have controlled the disease within reasonable bounds without national lockdown. And that includes actually China, Korea, Vietnam, Singapore, Japan, Sweden, et cetera, and also some recent examples of opening that have gone quite well. For example, Austria and the state of Georgia in the United States. As Fahad had said, the shock to output is already huge. Everybody understands that the United States economy may shrink at a 40% annual rate in the second quarter. And similarly large effects will be seen in Europe following an already sharp decline in the first quarter. So the situation is obviously grave. But if you look forward, the growth outlook will be determined by two opposing forces. On one side, the length of the lockdown, and on the other side, the force of counter-cyclical policy. These are the two main elements that determine the outcome. Both of these forces are now much better understood than they were just a few months ago. We now know that, as a rough approximation, the length of the lockdown is about 4 to 5 months, okay? From the moment the situation becomes grave to the moment they open. This is roughly the length of the cycle, some shorter, some longer. So 4 to 5 months is a short enough period that many large and medium-sized firms and middle-class households can finance the shock, can kind of hold on in various ways without outside help. However, it is a period of time that is long enough so that a large number of smaller firms and low-income households simply cannot cope. And without help, the effect on the productive and financial fabric of the economy will be immense, as many of these firms fail. And indeed, many families fall into destitution. This situation could also easily turn into a global financial crisis, a vicious cycle that eventually affects, through bankruptcy, the whole of the global banking sector. So these are the forces on the negative side. It looks to me that this worst outcome will be avoided. This is assuming that the opening does not lead to a major unmanageable second wave of the disease, which I think is unlikely in most places at present for various reasons. And mainly due, the recovery mainly due to the adequacy of the policy response around the world. This policy response has been much less coordinated than the one during the financial crisis, which of course I lived through. But it has paradoxically been a more powerful response. In the United States, this is where I am. This is the largest economy and the current epicenter of the disease. Fiscal stimulus in 2020 is estimated at 11% of GDP and 3% in 2021, with more programs currently under negotiation. This is a far, far larger response on the fiscal side than what happened in 2008 and 2009, which I believe is a crisis that was almost as dangerous or as dangerous as the current one, because it was a crisis that arose in the banking system that threatened collapse, which is less evident at this point here. The Fed's response has also been faster and more comprehensive than at any time, entailing several new lending and asset purchase programs. The Fed's balance sheet has grown by 15% of American GDP just in the last 3 months, with more to come. This compares to an increase in the Fed balance sheet of 10% of GDP over the whole of the crisis in 2007, 2009. Activity across the world is already stabilizing. You can see this in various indicators, including the oil price, the copper price, some investor surveys, the situation in China, which of course is early in the cycle, et cetera, et cetera. So I believe it is reasonable to assume that following the disaster of Q2 of 2020, we're going to see quite a sharp improvement in Q3, which builds into Q4, and then hopefully quite sustained growth in 2021. This recovery, in addition to the fiscal and monetary stimulus, will be helped by the fact that the crisis is somewhat staggered across the world. So China was early on, but is already recovering. Large parts of Asia are beginning to see acceleration of economic activity, and by classical pent-up demand after a long period of abstinence. I should also say that even in the best scenario, important sectors of the global economy will remain depressed even as they open. A lot of people, including people like me, will be reluctant to travel abroad, go on big tourism trips, take cruise ships, go to hotels, go to restaurants, et cetera, et cetera. So even in the best scenario, specifically the hospitality, travel, tourism sector will remain depressed until such time that the virus disappears. This is what I wanted to say. Of course, there are negative, there are risks on the downside in this scenario. I think those risks are probably going to be managed, even if there is a second wave. In a lot of the countries that have opened up, the second wave will be managed in a targeted way, targeting specific groups, targeting specific regions, rather than locking down the economy, which by then will also be politically unacceptable. That's on the downside. On the upside, of course, if we get the vaccine, that's the joker in the pack. That could really change the situation already early in 2021. I think I can say more, but I think I should stop there to allow others.
Yes. Okay, Yuri, thank you very much for your remarks and your insights and the outlook for the global economy. Now, it is argued that the coronavirus will fundamentally reshape global trade and very likely to reverse globalization by accelerating a move toward regional supply chains. In addition, we have seen some governments resorting to protectionism in hope of protecting their economies. The question is, could such policy hamper economic recovery, talking about the protectionist policy, and also regarding the diversification of supply chain? Is this going to be happening. To address these matters, I introduce with a pleasure the second panelist, Mr. Said Ackerman, who's co-chair of this task force and director for G20 Studies Center. The turn is yours, Mr. Ackerman, to talk about the COVID-19 impact on global trade and the trading system.
Thank you, Mr. Said. Can you hear my voice?
Yes, we do.
Okay. Let me take this opportunity to thank Task Force and T20 Secretariat for organizing the webinar, and also express my sympathies to those who suffered during the pandemic. Of course, it has been a very exceptional situation. My presentation will be on the impact of COVID mainly, and its impact on trade. But of course, it doesn't mean that it should be taken as a negligence of already existing structural problems embedded in the world trading system and the need for reforming it. And of course, COVID-19 increased the pressure on trade and trading system, cascading problems of global economy, where we already explained the general economic outlook, just to mention that it is estimated to lower the GDP, destroy income distribution, and the contracted demand and domestic production will raise the unemployment. And more importantly, I think the rise of the role of state over markets, as countries are inducing inward-looking policies to mitigate their dependence on others, whether we are going through a self-sufficiency period, as many attempts are trying to relocate investments and disrupting the GVCs, bringing them closer to home, and maybe rising duties that some countries are trying to use their tariff margins. So this is also having implications on trade and investment, which is I'm going to talk about. In the next slide, I just divided the impact of COVID on trade into two channels. The first one was the effect on trade on emergency measures for public health reasons, and these are understandable, especially with respect to restrictions on the export of medical goods. We had already tariffs before on many medical products, as revealed by WTO study, and you can see from the trade figures anyway. But also we had export bans on several products like masks, medical equipment, ventilators. This was the first imminent implication. The second is a much broader implication of pandemic on trade and trading system, especially arising from the containment measures. These are more on medium to long-term effects on trade in all sectors, not only in medical products, and on the global value chains. And because of the reduced investments, lockdowns, which caused underutilization of labor and capital, and contraction in consumer demand. And this actually was, is I think, more important aspect of COVID impact on trade. In the next slide, yes, there had been several studies about the effect of trade on emergency measures to fight with the pandemic, presented by WTO, by Professor Avenit and some others. In the next one, the next slide. Yes, the post-COVID measures in medical products. The medical products actually represent just 5% of world trade, but still its amount is over $1 trillion. And major suppliers are, just a few countries are the major suppliers of medical products. In the top 10 exporters, 6 of them being the G20 members, account for almost 3/4 of world export of medical products. That means that although there is domestic production, but during the pandemic, shortages led many countries, even major suppliers, to change their policies to keep essential supplies at home. So this has been the impact on trade. So access to medical products in fight with pandemic has been found essential. So beyond tariffs, I think the export policy side is quite important. Many countries, almost all G20 members, with some exceptions, already implemented limitations on medical products, as you can see in the map. And in the next, these are the emergency measures and their implications very briefly, just to make a stock taking. But we had more broader implications of pandemic on global trade and trading system based on some estimations. The WTO forecast, for example, that the world trade will be expected to fall by between 13 to 32%. Of course, these are some estimated numbers according to different scenarios. World Bank also had a similar study based on a CGE modeling, which claimed that the exports from major countries, but also from other countries, will decline very severely. So in some of these countries in services, in some other countries, mainly in manufacturing, for understandable reasons. And these are more broader implications, and depends on how long it will continue, how long this pandemic will continue, whether it's a one-time shock or whether it will be recurring. The next slide says that the WTO, according to WTO estimates, we know that the optimistic scenario just waits for a recovery to pre-pandemic levels in 2 years' time, but it could be prolonged depending on the uncertainty. They had a pessimistic scenario, which could actually bring two-digit declines in trade volumes of almost all countries, where North American countries are hit hardest. And the more complex GVCs are also hit hardest and distorted, like in electronics, automobiles, chemicals, or plastic industries. The case in trade and services is also quite important because they were developing last year as opposed to a decline in manufacturing in 2019. The trade and services are most directly affected by the restrictions of movement, of course, the transportation, hospitality sector, tourism, recreation, though some other sectors in services are better off, like information technology or deliveries maybe. The next one, please. This familiar graph from the WTO explains that after each crisis, it's becoming very difficult to return to the previous trend that happened during in the aftermath of the global financial crisis. And we don't know whether the same will happen, or we can turn back to the trend very easily after COVID-19 pandemic. Of course, it depends on whether it will be recurring and whether we can just rebound trade to the previous levels. Of course, this partly is dependent on which trade policies will the countries implement and will react to pandemic. The next one, please. Yeah, maybe we can just say a few words about the G20 and the role of Trade and Investment Working Group could do in this context. The G20 Ministerial Statement on March 30 was bringing some tasks on the Trade and Investment Working Group, both for emergency measures and for broader aspects of trade. And they said that they actually agree on the emergency measures designed to tackle the pandemic, and they must be targeted, proportionate, transparent, and temporary, and are consistent with the WTO rules. The next one, please. Of course, it's not very easy to have a very targeted policy for many countries as they started implementing severely restricting measures at the beginning. And excessive measures should be refrained, that they should be proportionate only to tackle this COVID-19. But how to measure this? It is not very easy, whether all these policies implemented were proportionate so far. Transparency is quite important because many of the measures taken were not notified very clearly under the WTO procedures, and maybe more than half of the G20 countries did their notifications very properly. That they should be temporary, only for a limited time period to fight with the pandemic. But some countries, I see that they lift their bans, but very late. And some other countries still keep their bans, especially on the export side. With respect to the consistency with the WTO rules, of course, pandemic indicated that a general ban on quantitative restrictions in GATT agreement on the exports is not sufficient, and member states can easily cover their restrictions under some legitimate exceptions, like protecting human life and health, and to address critical shortages, and even national security, for national security reasons. The first two were implemented actually for human health and critical shortages, but they should be actually put into a very clear criteria. That's one issue that G20 countries should deal with in the Trade and Investment Working Group somehow. Maybe they can just, in the next slide, we can just formulate that plurilateral agreement on trade in medical products could be studied and instituted, if possible, where they can address lowering tariffs, but not only for the import side, but more importantly, regulating export bans and export duties. It's not only export limitations on the quantities, but export duties should be taken under consideration in a strict criteria, and facilitating trade, abolishing impediments that we experienced during the pandemic on cross-border movement of health-related services. This is a part of trade in services. So it's a multifaceted agreement, not only covering manufactured goods, but also services, and providing funding maybe for vaccine research, and subsidy regulations should be adopted as such to facilitate research and development in vaccine and medical goods, and relax their technical standards in emergency cases. Some G20 members can do this by starting implementing much flexible standards, and ensure that the intellectual property laws do not impede access to vaccine and medicines. This is just a stock taking of what had been offered by different studies, just to remind you. And the next one, it's not only emergency measures, but the G20 Ministerial Statement also talked about longer term actions, just asking the working group to address issues and provide longer term actions to be taken to support the multilateral trading system. The actions should not be confined to COVID-19 only to support the multilateral trade system, but should encompass reforming the WTO system to cope with its structural problems that we're already facing. The next one, please. Yes. Yes, we know trade is slowing in 2019 before the virus struck, but the WTO has been facing the crisis long before the pandemic, especially with reference to its structural problems like negotiating function and dispute settlement function. Just, I will be finishing in 2 minutes, but the next slide, please. For the negotiation and for the dispute settlement functions, I can just separate them into two, but they are interrelated. For the negotiation, we don't have new rules for decades, with the exception of meager agreements in some areas. Consensus building is extremely difficult. New negotiating methods are required, maybe plurilateral agreements, and new cooperation mechanisms are needed. with respect to the dispute settlement, of course, we have the very serious issue of appellate body deadlock. The next one, please. We can skip this. The next one, yeah. What G20 could do to support the multilateral system, they can give a mandate to the Trade and Investment Working Group, maybe a larger mandate to initiate a deliberative framework within which they expedite major challenges to be addressed and some proposals for actions. And these are actually very much relevant to many of the issues that we covered under task force policy briefs, like, for example, subsidies, that I believe Peter will elaborate this issue more broadly, digital trade, services, SMEs, negotiation techniques like plurilaterals, diversification of trade, and maybe also they can work on an agenda for the next ministerial conference. The next thing they could do is to examine the trade impact of pandemic measures to contain COVID-19. We need a very clear analysis of what happened and how trade policies were implemented and whether they were effective or not. In that work,
I don't mean to, cut you short, Mr. Ackerman, but
okay.
In the interest of time.
This is actually the end of my presentation, and the presentation could be distributed to others. And but I believe that the alternative actions like interim appeal arrangement for the dispute settlement should also be scrutinized and followed up by the G20 Trade and Investment Working Group with respect to its operation. So I stop it now, and I'm happy to be with you. Thank you very much.
Thank you, Mr. Ackerman, for this insightful and presentations. You touched on many challenging issues facing WTO. And as you pointed out, that the urge to achieve medical supply independence came through a combination of export controls, preemptive purchasing, alleged state-sponsored seizure of goods in transit, and also state-mandated production and domestic industrial subsidies. All these represent definitely challenge to WTO. But the question is, do these issues present an absence of any role by WTO? And is there a lack of international policy coordination? You touched on the G20, but apparently that the WTO had been lagging behind in terms of acting to assume leadership regarding this pandemic. To touch on this topic, Mr. Peter Draper, who is a co-chair of this task force, also Executive Director, Institute for International Trade, will join us from Australia to talk about pandemic-proofing the trading system, the role of the WTO. Peter, it's your turn.
Well, thank you very much, Said, and I appreciate the opportunity to speak tonight. Well, tonight for me, I guess it's afternoon or morning for others. I actually have just two substantive slides, and they cover fairly similar terrain to what Said ended with, so I can be pretty brief. I thought it's important to start off with setting the scene, which is the WTO reform process before the COVID-19 pandemic broke out. And so some brief thoughts to set the scene. And then how do we harness the policy momentum, if you like, behind the disease in order to reform the WTO? So what can be done? So next slide, please, Abdullah. So this also draws on some of the work that we're doing in the task force, some of which Said has just presented, and that's a joint policy brief that he's leading, and I'm a co-author on that one. And there we're really trying to diagnose what are the current problems and what are the issues in the reform debate. We could spend a lot of time just on this. I would just highlight three particular reasons that multilateral accords have stalled in recent years in the WTO. And here I would distinguish between multilateral accords, which the entire membership embraces, and plurilateral accords, which are a subset of the membership embraces. And there's different ways in which that can be done, but we don't really have time to get into those details. So in my mind, there are three issues at the center of the impasse. The first is the issue of special and differential treatment for developing countries. So countries at different stages of development, what kinds of commitments should they take on? Should it be the same scope of commitments, etc.? Should they get aid for trade to support them, and so on? And fairly recently in Geneva and outside Geneva, this has become a very hot issue with the US in particular, very unhappy, particularly with the continued claiming, I suppose, of countries like China as or of developing country status, which has long been, if you like, a self-declared right in the WTO, but has become controversial. I think that relates to the second issue, which is another issue that not just the US, but other particularly developed countries have been raising increasingly of late, and that is the issue of state capitalism, and particularly how so-called state capitalist countries can be accommodated in a body that is supposed to be designed to accommodate market-based economies. And really this is crystallized around the issue of reforms to industrial subsidies. And as Saeed said, we have prepared another briefing on that issue, which I am the co-author of, but many others have written on this topic too. It also gets into issues around state-owned enterprises and payment of subsidies to and through state-owned enterprises. And then the third issue is this question of should the entire membership be involved in agreements, in negotiating all agreements? Should they be housed under the single undertaking, which was the Uruguay round modality, or should we rather go for plurilateral smaller group approaches, critical mass accords, whereby you minimize the problem of free riding, and so on. So these for me are the core issues at the heart of the impasse in the WTO. There are others, but I would highlight these. And most recently, of course, as Saeed mentioned, the appellate body is the most high profile hostage, but it's not the only hostage. So for instance, the e-commerce tax moratorium has been held up now for some time. And of course, COVID-19 had a role to play in that, leading to the postponement of the recent ministerial meeting that was supposed to take place. So the bottom line is the members were sharply divided prior to COVID-19. Progress was and is challenging. But there were some signs of life, and particularly in the joint statement initiatives, and I guess others will pick up on this later. And I would say, especially with respect to the e-commerce talks, notwithstanding the substantial headwinds that they face. So next slide, please, Abdullah. All right, so what can be done in the WTO to harness COVID-19, so to speak, to the WTO reform agenda? Like Saeed, I would advocate for a plurilateral approach, or a combination of a plurilateral approach actually and multilateral, and I'll start with the plurilateral. So the first is harnessing some of the momentum around the reductions to import duties on critical health equipments and pharmaceutical products and related inputs that we have already seen, and particularly those necessary for sustaining cross-border value chains and to enable them to function as smoothly as possible during pandemics. And this can build on an existing pharmaceuticals accord that's already in the WTO as a plurilateral agreement. I would add to that, build on it, clarify what we mean by essential goods and services. So use the plurilateral agreement to drive forward that discussion. And forge an accord around that to govern trade in these essential goods and services during health crises. And I add services in consciously because many of the most affected sectors in this crisis have been services. So transport services, to take one obvious example, but also logistics services, port operations, movement of workers, which is a service too. All of these have been seriously affected and have seriously impacted the operation of not just essential goods value chains, but value chains writ large. A third element that I think is important is to contain, firstly, then manage, and then finally roll back where possible, the essentially massive subsidization that we're seeing of domestic firms as a result of the COVID-19 rescue packages, which is not to deny the legitimacy of those packages, but to anticipate a time when those packages will no longer be needed, and they need now to be rolled back so that trade can be minimally distorted from that point on. And that will be a very difficult undertaking because we all know once subsidies are paid to firms, they're very difficult to claw back. Now, for all of this, I think that G20 members in particular are central. So any critical mass plurilateral in the WTO has to involve the G20 membership at its core. But to that, I would add multilateral negotiations to tighten, but I deliberately say not eliminate, the conditions under which recourse to the GATS exceptions clauses could be made. And I make that deliberate clarification because elimination of the exception clauses is a non-starter. It's not going to happen, but we can contemplate tightening those exceptions. And particularly recourse to export restrictions. We all know the self-defeating impacts of export restrictions. We saw that in 2008 through the food crisis. We're seeing it now in the context of medicines, for instance, and critical health-related products. I would add to that, drawing on the pre-COVID trade wars problems, the national security exception, even more controversial, but that doesn't mean it shouldn't be on the table. And it certainly interacts very negatively with the pandemic. So that's all I have to say. Happy to discuss further.
Thank you, Peter. Now we're moving to the second panel discussion, and we have three panelists in the second part of this webinar. The topics that will be covered in this section cover investment and cover also FDI, e-commerce, and implications on developing countries. Obviously, pandemic is impacting emerging markets through an unprecedented mix of domestic and external shocks, whose combined effects are very hard to predict. And the impact on emerging economies will be covered in this session. The other important issue that will be talked about is the role of capital flows, that capital flows to emerging markets are rapidly receding, while global risk aversion has spiked due to tightening global financial conditions. Now, to cover capital flows, FDI, and e-commerce, I will first introduce Mr. Matthew Stephenson, who's Policy and Community Lead, International Trade and Investment, and he's a task force member and lead co-author. The topic he'll be covering is digital FDI and sustainable FDI for COVID-19 recovery. Mr. Stephenson, it's your turn.
Thank you very much, Mr. Al-Sheikh, and thank you very much for the invitation to present today on behalf of my fellow co-authors. Mr. Al-Turki earlier encouraged us to present new initiatives, and my presentation will suggest a few very concrete options to help tackle COVID-19. The world is undergoing a great digital transformation. This was already taking place before COVID-19 struck, but COVID-19 has accelerated this trend. One business executive I spoke to estimates by up to 5 to 10 years. Even if we find a vaccine tomorrow, and Mr. Dadouche was quite hopeful that it might come sooner than expected, this digital transformation will still take place. There will be winners and losers, as there always are. There are likely 3 types of firms: those that will thrive because their business models are digital friendly, those that will not make it, again, because of their business models, and those in the middle that will struggle but adapt. Now, the question for policymakers and firms alike is how to support this third category. How can we accelerate adoption of the new normal by increasing firms' digital competitiveness? Ultimately, the right support of the state to these firms will lead to restored economic growth as firms manage to adapt, become more competitive, create jobs, revenue, and so forth. One way is through attracting FDI in the digital economy, or what I like to call digital FDI. The World Economic Forum launched a new digital FDI initiative that seeks to identify the policies, regulations, and measures that governments can adopt to attract such investment and grow the digital economy. The aim is to discover the secret sauce, so to speak, to creating digital-friendly investment climates. Attracting digital FDI may require very specific policies and measures. Digital firms have business models that vary from traditional bricks and mortar businesses. Digital firms rely heavily on data and technology, involve platform economies, and leverage non-traditional assets. So here you see in this slide the framework that we have suggested can be helpful to think through these options. We're building on the work of UNCTAD in its 2017 World Investment Report. In this report, UNCTAD suggests that these enabling policies, regulations, and measures can fall into 3 pillars, and you see these 3 on the slide in front of you. Enabling investment in digital firms, such as Uber. So this is completely new types of activities, new firms. Enabling digital adoption by traditionally non-digital firms. So these are existing firms and existing activities that move into the digital space. Think of telemedicine or mobile banking. And enabling investment in digital infrastructure. Think of especially the controversial 5G today. Now, to help answer these questions, we are conducting a global survey, the World Economic Forum, of 300 technology firms, asking investment decision makers in each firm to identify within each of these 3 pillars, what are the most important policies, regulations, and measures that they would need to see to make a host economy attractive for digital FDI. For instance, to what degree do data localization requirements impact investment in digital firms? To what degree do taxes on digital services impact digital adoption in traditionally non-digital sectors? And to what degree do international standards impact investment in digital infrastructure? I mentioned these just as examples, as illustrative examples, because data localization and digital taxes have been very controversial in the news. And so this analysis can help us unpack a little bit how important it is to firm decision-making when it comes to investment. Of course, policymakers will need to balance different considerations besides just firm preference of what they wish to see in terms of regulations. But it is an important starting point to know what policies, regulations, and measures can make an economy relatively more attractive to these flows of capital. This initiative, Digital FDI, was first conceived and planned about a year ago, well before COVID-19 struck. It took us a while to develop the right academic partners to guide the process, peer review our survey, and so forth. We hired a specialized firm to help with data collection with the survey. But this survey is now live, and we should have results sometime in the next few months, and can preview these in our T20 policy brief, in addition to a white paper, and share it with G20 decision makers. We are looking for partners in this effort, especially in the next phase, to consider implementing what we find in this data gathering in terms of the policies, regulations, and measures identified. So if G20 economies are interested in this work and moving to an implementation phase, we would love to talk to them. At the same time as driving digital FDI, I would suggest we should not forget the bigger picture, however. The bigger picture is that to make sure that FDI contributes to the well-being of people and planet. In other words, to ensure that FDI contributes to sustainable development writ large. As Carl Sewell has called it, sustainable FDI. Next slide, please. The two approaches can be complementary. Digital FDI policies and measures are specific to digital sectors and activities, while sustainable FDI policies and measures are horizontal and apply uniformly across all sectors. In the case of sustainable FDI, our knowledge is more advanced. We are working already in certain country-level projects to identify policies and measures to advance sustainable FDI. The Forum currently has projects in Cambodia, Ghana, India, and Kenya. And instead of a three-part framework, as with digital FDI, in sustainable FDI, we are using a five-part framework that you see on the slide in front of you. We see sustainable FDI as being driven by policies and measures across policies, finance mobilization, promotion, facilitation, and development impact. Now, in each dimension, there are different tools or levers to help move investment flows in a sustainable direction. And as we know, the right lever of the right length can move the world. Policymakers and firms need a clear picture of the different levers to effectively pursue and coordinate sustainable investment efforts. Now, within this framework that we describe in more detail in our policy brief, we also suggest 6 very concrete measures that G20 economies, and other economies for that matter, may wish to consider taking. The idea is to be very practical and direct. First, consider including internationally accepted standards and guidelines, for example, from the UN, OECD, and ILO, in domestic frameworks and international investment agreements. G20 economies have already started to integrate these in their domestic frameworks, such as China, the EU, and the US. What is new is that these standards are increasingly being included in IIAs. For instance, in 2018, 4 international investment agreements reference such standards, and they are being considered as well for inclusion in the WTO framework on investment facilitation for development that's currently being discussed. Second, consider making corporate social responsibility programs a requirement for firms above a certain size. For example, India and South Africa, amongst G20 economies, have taken steps in this direction. India has made CSR programs a requirement for firms engaged in inward FDI, and South Africa has made CSR programs recommended but voluntary for South African firms engaged in outward FDI in Africa. Third, adopt sustainability reporting requirements for firms. Reporting is essential for stakeholders to allocate capital according to societal values, with firms that score well being rewarded with greater investment, tax breaks, and so forth. Fourth, align incentives with sustainability behavior of firms. Governments can either make incentives conditional on sustainability behavior, a form of stick. If you don't invest sustainably, we will not provide it, or provide additional incentives to firms that make more of a contribution to sustainable development, a form of carrot. If you provide additional sustainability contribution, more jobs, more training, we will give you additional support, additional incentives. So there's a stick approach or a carrot approach. Either way, it's aligning incentives to sustainability behavior of firms. And in the case of the carrot approach, we suggest in our policy brief the idea of operationalizing this approach through the concept of creating a recognized sustainable investor category. Fifth, ensure special attention is paid to the sustainability of infrastructure investments, given infrastructure's lifespan and its impact on climate change. And sixth, adopt a number of practical steps to create linkages between foreign investors and local firms, which, as we know, is one of the keys to investments development contribution. Now you might say to me, Matthew, in the current context of FDI falling by about 40%, maybe more, according to the latest estimates, this is not the right time to include additional measures that might slow or hamper these flows. Let's wait until FDI is back up before considering any new measures. I would suggest this would be a mistake to think along these lines for 2 reasons. First, the measures I've outlined can actually help improve the investment climate and thus can support an increase in the level of investment, especially over the longer term. Consumers want to know their firms are following international standards and guidelines with respect to human rights, the environment, and so forth. they increasingly reward such behavior with greater consumption of goods and services of such firms. Firms, on the other hand, would be happy to have more additional incentives for additional sustainability contribution. And they thirst, international firms that are seeking to invest abroad, they thirst for good infrastructure and for linking with qualified domestic suppliers. So if they see either of those in a host market, they will be more likely to invest in that particular target market. Second, the second reason why this is maybe the right time to think about these measures and not the wrong time, this is really an opportunity to reshape the system. To offer a metaphor, it's when the factory line has stopped that you can change the belts and bolts. Once it's going again, it will be more difficult. So this is an opportunity to change the bolts, so to speak, in the factory line of foreign direct investment frameworks, to make those bolts of a stronger material, or in other words, to adopt investment measures that will make more of a contribution to sustainable development. Next slide, please. So how to implement these ideas in practice? We want to be very practical here. In our policy brief, we suggest the G20 should create an international investment support program consisting of two parts, an investment facility and an investment fund. These are essential to help get FDI flowing again and thus contribute to economic recovery. The facility would help coordinate efforts to restart investment, facilitating public-private partnerships to tackle specific bottlenecks identified by governments and firms, especially regarding digital FDI and sustainable FDI. And we have a model for this, an effective existing model in the space of trade facilitation, called the Global Alliance for Trade Facilitation, where firms and governments come together to tackle specific trade bottlenecks. And I think the same could easily be imagined in the case of investment and investment bottlenecks, building on an existing effective model. The fund, in a complementary way, would provide resources for targeted technical assistance and implementation of these measures in practice, the resources to do the activities and the partnerships identified by the facility. To conclude, even though we talk about FDI, and in my presentation I've mentioned FDI, these efforts can really benefit both foreign and domestic investors. So it would technically be more accurate to use the terms digital investment and sustainable investment rather than just digital FDI and sustainable FDI, as these measures and programs and frameworks can help unlock and support both domestic and foreign sources of capital. And I think this is very important to underscore so that on a political economy level, we get the support not only of international investors, but also of domestic firms that see these efforts as benefiting their own business models and their own economic opportunities. Thank you for your attention. And if any of this is interesting and useful, I would invite you to look at our T20 policy brief for more details. Thank you.
Thank you very much, Mr. Stephenson, for this thorough presentation of your policy brief. As you highlighted and defended the opportunity related to the digital FDI and sustainable FDI, the situation with digital trade may be more promising in the immediate term, and as had been the case during the COVID-19. To talk about the digital trade and COVID-19 in the era of data-driven economy, I invite Dan Suryek, who is a senior fellow at the Center for International Innovation, to talk and do his presentation. Mr. Suryak.
Thank you very much, and it's a great pleasure and honor to be in such distinguished company. And I must say, one of the advantages of the pandemic and the digital transformation is that it's a lot easier to get to these conferences. So in terms of my remarks, I'll start off with a few points of preamble, which is to emphasize that the year 2020 marks a break point in global economic history, and I think this will be clear when we look back on it. Regardless of the shape and the speed of the recovery, whether it's a V-shaped, W-shaped, or a Nike swoosh-shaped, as people are now talking about, we will not really be going back to the patterns of production that prevailed pre-pandemic. And by the same token, international trade will face a relatively wrenching adjustment. I would mention 4 key drivers of this. Matthew has already mentioned the acceleration of the digital transformation by 5 to 10 years. This is a huge impact on how things will be produced and therefore how they will be traded. There will be some mean reversion in the sense that as we move away from into the post-pandemic era, face-to-face will resume, especially with the exchange of tacit information and the capture of social value, where there are local externalities to be captured. This will resume, of course, but however, many of the areas where there are efficiency gains and cost reductions from the digital transformation, these will take root. We are having a lot of natural experiments right now, testing out the new normal. A second point is that the transition to the data-driven economy is putting into play vast rents that this economy generates. And these will only grow with the rollout of 5G networks, which has actually been slowed down by the pandemic. But these rents induce strategic behavior both at the corporate level and at the national level. And the rules-based system has never been good at regulating a contest for rents. So that will also be a major shaper of the post-pandemic economy. The third point, Matthew already has also mentioned, the business landscape will be changed permanently as a lot of legacy institutions and companies are swept away by the downturn. And meanwhile, there will be lots of room for new green shoots coming up of new business models and so forth. And I guess the fourth point is that we have entered a period of an international institutional interregnum, if you will. The evolution of the economy does not seem to be constrained any longer by significant institutional guardrails. So coming out of the pandemic, I think patterns of trade will change along multiple vectors, including consumer patterns, business strategies, and of course, this technology-driven national contest for rent capture and power. So if I can put up the first slide here. And this basically sets out a taxonomy of the forms of digital and digitally enabled trade. And I'll speak briefly to how these are being impacted by the pandemic. So mode 1, which is basically the cloud services or internet services, this type of economic activity is surging massively with the pandemic. So we're seeing 50 to 70% increases in internet utilization. The internet has remarkably held up very well under this surge, and it's a testimony to the value of a very broad-based network approach to managing these kinds of things. But we're also seeing a significant increase in things like streaming services and social media use. And of course, all of this drives revenues into the pockets of the internet majors. So this is very significant commercial implications. Mode 2 is the traditional e-commerce activity. This is includes business to household and business to business digitally mediated transactions. This is what's being negotiated in the WTO. And here we're also seeing major gains in some sectors, for example, such as supermarkets and retail technology are seeing massive surges in their internet traffic, over 100% increase relative to a reference from last year. But we're also seeing some other sectors, such as tourism, seeing a total collapse. And this kind of emphasizes that this traditional e-commerce world, the digital lives in symbiosis with the physical, and it largely reflects what's happening in the physical domain as well. So you have, therefore, mixed outcome there. Mode 3. And this is basically household to household or real services digitally mediated. This is, you can think of this as the sharing economy, and it has been hammered. by the pandemic. So you have, for example, Uber has seen its a profit loss margin of minus 83%, which is remarkable. At the same time, I'll talk about this later, its market cap has actually recovered quite well. Airbnb, another star in the sharing economy, has laid off 25% of its staff. And it's a really interesting question as to how this particular economy will rebound, and whether the advantages of formal establishments such as hotels and so forth, which can be regulated better, will reassert themselves in the post-pandemic economy. Mode 4 can be thought of as the gig economy. This is household to business services, and what we're seeing again is a significant unmooring of the physical relationship of workers and companies. This is establishing a much greater scope globally going forward for what would be effectively mode 4 services, i.e. the movement of persons, but digitally, not physically. And there is a question of, to what extent borders will really be relevant in this future production economy, to the extent that it could be serviced in this gig economy fashion. There are also significant questions of monetization of the input that's being put onto the web by households. Moving on to mode 5. Mode 5 can be thought of as data as the new oil. This is the value of data that's being captured internationally by the platform firms primarily. We know that data is not primarily traded in terms of there's no paper trail of invoices and receipts. It's only reflected in the market capitalization of the data-driven firms. And what we are seeing here is, in fact, that the data-driven firms are seeing a significant rise in their market cap. Amazon, for example, has had a $400 billion boost since the initial downturn, and that's a huge amount of money. So a part of that's monetary policy, but part of that is actually, again, the market capitalizing the value of the data that is being hoovered up or vacuumed up from around the world. This particular mode of trade puts into play a significant battle for sharing of the rents. And if you haven't been following, there's been a very interesting development in Canada, which is the development of the waterfront in Toronto, where Alphabet, through its subsidiary Sidewalk, had planned to build up a new smart city from scratch, and they just walked away from this. And part of that was over the battle for the rents that this new economy generates. So the bottom line here is that whereas physical trade has plummeted, digital trade, most of this is not measured well and not captured in statistics. We can say that data is everywhere but in the national statistics. But digital and digitally enabled commerce has been growing very rapidly, being boosted by the pandemic. This is the bright spot. Much of this is local, but while traditional trade is depressed, I believe that when we, in the final reckoning, we will see that digital and digitally enabled trade have been expanding. This is the bright spot in this pandemic economy. So I'd like to then just comment briefly on some of the governance issues that are being raised by these developments. I think the first point is that we have platform firms now that have more clients than the populations of the United States, China, and the EU combined. Now, these are massive firms in that sense, and they've got enormous power and command of data, which is the foundation for that. So the pandemic has actually put wind in their sails and has expanded their value, and there are issues there. In particular, for example, there's the antitrust issue. There's a great concentration of market share and power in the digital economy, and we're seeing some of this start to play out. I would, if you're not following this closely, I think it's worthwhile looking at is in Texas, there's an antitrust investigation of Alphabet being launched. And this will be very, very interesting to see, because this is, again, within the United States, not internationally, but has significant implications for how the digital economy will be governed going forward. And also, as I mentioned, Amazon, which had just had a $400 billion boost to its market cap, which is, bankable assets, they've just ended the hero pay for their frontline workers. And this is the distributional tension that was driving populism. So the pandemic is intensifying many of the issues that had been identified in the digital economy pre-pandemic. I think another particularly interesting issue driven by the pandemic is that networks have empowered professional collaboration globally at a really remarkable level. I've been following the way epidemiology has been working. The international collaboration there is astounding, and it is driving a very, very rapid scientific investigation into this virus, and I think this is, again, laudable, and this is one of the brilliant things of the digital economy, if you will. A point of issue that needs to be addressed, I think, as we look at the future international institutional framework, is that this is a time of unprecedented need for global public goods. And this includes, to address the pandemic, of course. We're not safe until we're all safe, but it also includes climate change, and also includes the regulation of the data economy, because data has got very strong public good characteristics. And this is a unique point in time, since we have actually, as I said, we're into an institutional interregnum of sorts, as the United States has been basically walking away from international institutions which it helped design. I guess the fourth governance point is that the rents over the digital economy, particularly, I think the 5G network rollout, have been a significant contributor to the mounting geopolitical tensions over intellectual property and trade. And of course, the pandemic has intensified these tensions through the blame that's being cast as to the cause and the source of this. And this is very disturbing, because it is driving a realignment of supply chains throughout, and also intensifying the digital divide, if you will, and leading to a potential framework for the digital economy, which will feature warring realms as opposed to a global internet network structure. So for third parties who are not China and the United States, this is a very disturbing development. I think this is an area where the G20 has to potentially come forward with ways that we can reduce these particular tensions. So turning to the long run reforms, I would emphasize a few things here. One of them is that the WTO 2.0, I think, will have to have a much broader range of reforms than what is currently on the table, certainly in the e-commerce area alone. As I mentioned, e-commerce is just one of the 5 modes of digital and digitally enabled trade that we can identify. So we need to broaden this discussion. The Center for International Governance Innovation, where I'm a senior fellow, has put together a wide-ranging review of issues, and I would recommend that to this task force. We have out there as well the Digital Economic Partnership Agreement negotiations started by New Zealand, Chile, and Singapore. This is still in a very early stage, and it's got little substance as far as I can see in terms of its development, but it is starting to get towards the broader framework that we require for the WTO 2.0 for the digital age. The G20 initiative on free flow of data with trust, which was developed under Japan's leadership last year, this is a useful model. It also gets at the broader range of issues that the digital economy is throwing up. Unfortunately, right now, there's a real vacuum on trust in the system with the press for decoupling. So this is a question: how do we, again, pull things back and together? I guess a final point I would like to emphasize is that it's the relative primacy of trade negotiations versus developments in other areas of the digital economy. The digital economy is really quite different than the old industrial economy for which the WTO was developed. It raises a plethora of issues related to, of course, privacy, national security, industrial policy, cultural policy, and so forth, which need to be sorted out. And there is a need, in some sense, for not necessarily more policy space, but different policy space than was provided by the old WTO. And it's not clear that trade negotiators should be actually developing the rules first and constraining the space for these in these other areas. And for this reason, again, my center, the Center for International Governance Innovation, has called for a digital stability board modeled, of course, on the Financial Stability Board, which would be essentially tasked with addressing these more complex issues as they feed into the trade arena, and then to basically have this interface with the trade negotiations. So I will leave it there. I think in contrast to much of the rest of the global economy, the digital economy has been growing and has been boosted by the pandemic. And this is one of the, I think, great features of modern technology here. So I'll leave it there.
All right. Thank you very much, Mr. Suryak. You know, many countries, including emerging and developing countries, entered the pandemic with very low interest rates as well as high debt. And apparently, you know, with the after the pandemic, they will have, you know, higher debt. What are the implications on the developing and emerging economies in such environment of low interest rate and high public debt in the immediate term and in the longer term? To talk about the implication of pandemic on developing countries, I invite to speak Mr. Carlos Braga, who is Associate Professor at Findaco Dom Cabral, Brazil. Mr. Braga, the floor is yours.
Thank you very much, Said. And I thank the organizers for the invitation. I hope you are hearing me well and can see me. I will basically be very short because I have the benefit to be the last speaker. And I feel a little bit like Danny Kaye that also went to a conference, and before him, the Indian ambassador made a wonderful speech. So when he came to the floor, to the podium, he just said, I wrote that speech. So I basically agree with most things that have been said so far. But I would like to focus on the differences of the pandemic in terms of the world economy and its impacts on developing countries, vis-a-vis what we saw, comparing with what we saw in the context of the global financial crisis. So the first point is to emphasize the fact that any scenario at this point in time, it's very difficult because we are really living in unprecedented times, as Dan just pointed out, with certain things accelerating, like the transformation of the world economy towards a digital economy, and many other things in real life actually having a very depressive impact. We heard from Uri and from Peter and also from Mr. Ackman in terms of the prospects for trade growth in 2020 and 21. The first thing that I would argue is that when we talk about scenarios, I like to mention John Kenneth Galbraith, that used to say that there are two classes of forecasts. Those from people who don't know and those from people who don't know that they don't know, because it's obvious that it's very difficult at this point in time to define how the world economy is going to look like at the end of 2020 and in 2021. But if we compare with the global financial crisis, and at that point in time, I was the director of economic policy and debt of the World Bank, there are some major differences. In 2009, we saw a major impact in terms of economic growth in industrialized countries. So, and the world economy had a recession of the order of minus 0.5% of global GDP. But in the developing countries, initially suffer much less, particularly because China continued to grow at a significant pace in 2009. So nowadays, we are in a moment that we are combining supply shocks with demand shocks. We expect, using the IMF data, a contraction of the order of minus 3%. So this is 6 times bigger than we saw in 2009. And it's, of course, affecting not only advanced countries. The expectation is that they will contract on average 6.4%, and emerging and developing economies, the expectation is that they are going to contract 5.6%. So in this context, it is obvious that the expectations in terms of investment flows and trade flows for developing countries are going to be significantly affected. So when we talk about scenarios, we all became, over the last few months, amateur epidemiologists, and also began to look a lot in terms of the geometry, the shape of the recovery. The most optimist ones, and Uri gave a good example in this context, suggest that this is a temporary one-time shock, and this is embedded, for instance, in the WTO scenario for trade growth in 2020. Even in this context, we expect a contraction in volume of trade around 12 to 13% vis-a-vis 2019. And it's important to remember that since the global financial crisis, trade, international trade, had lost a significant part of its dynamism. So if in the 1990s international trade, the GDP trade elasticity was around 2 to 3, over the last few years, it has been around 1. And even below 1 in some years, as was the case in 2019. So even in a very optimistic scenario, we are going to experience a significant trade impact. Now, this is a V-shaped recovery. And for this to happen, of course, 2 important hypotheses are embedded in this kind of scenario. One is the idea that we are going to have a moderation of the impact of the pandemic, either because we're going to have therapeutical solutions in the near future, or a vaccine is going to happen. I'm not going to comment on those, but I just say that it's very unlikely that we are going to see this happening in the next 6 months or so. And the other is that the implications of government policies around the world that will have no doubt a significant impact in terms of economic activity. This time, monetary and fiscal policies, although as has already been pointed out, not in a coordinated fashion, as we saw during the financial crisis, but each country, all of us are now Keynesians. So the average fiscal expansion in industrialized countries is well above 6% of GDP. In the case of the United States, more than 10% of GDP. Even in a country like Brazil, where I come from, the expectation, the announced measures are around 6.5% of GDP. So the optimist view is that we will not have new upsurges of the epidemic, and on top of that, this fiscal and monetary stimuli are going to have a significant impact in terms of the recovery. Most analysts are a little bit more pessimistic and believe that we are going to have a U-shaped type of recovery, so it will take longer. But I tend to believe that probably based on the experience of past pandemics, we are going to have a W-shaped type of recovery, in the sense that, yes, the stimulus that we are seeing around the world will make a difference, but we will have new upsurges of the epidemics till either a vaccine or effective therapeutic solutions are adopted. So in this context, what all of this means for developing countries? This time, we expect the impact on trade of developing countries to be almost as significant as for industrialized countries. The IMF, for instance, expects a contraction around 9 to 10% in the volume of trade of developing countries. Not only that, of course, it will all depend on how commodity prices are going to evolve. And we know, at least in the near future, oil prices are among the most depressed of the commodity price, and this has significant implications all over the world, particularly for oil exporters. But to finalize, one point that characterizes this crisis, and it's different from the past, is what is happening with services activities and, of course, trading commercial service around the world. As Uri and others already pointed out, tourism, air travel have been significantly affected and most likely will continue to operate in a very depressed environment. For countries like the Caribbean islands that depend significantly on tourism, this can be devastating in the sense that it not only affects a big chunk of the economy, but also has externalities for other sectors, for instance, food producing for hotels in the Caribbean islands is dramatically affected at this point in time. And now globalized industries, those that depend on complex global value chains, like for instance, electronics and the automotive sector are being significantly impacted. And this, of course, impacts opportunities for diversification of developing countries. One good example, as I mentioned in the beginning, I'm in Brazil at this point in time, in São José dos Campos, which is the city of Embraer, the third largest aircraft producer in the world. As you can imagine, the aircraft industry, the three biggest, Boeing, Airbus, and Embraer, are being significantly impacted by the decline in air travel. And all of this, of course, creates very negative externalities in the medium term. So this is a moment for the G20 really to implement many of the measures that were already pointed out as alternatives in terms of supporting foreign direct investment, avoiding trade restrictions, particularly with respect to medical supplies, but also to foster a sense of solidarity in the middle of this crisis that is fundamental. If you ask me if I'm optimistic at this point in time, I have to say I am not, because the liberal trade order for it to be sustained and to thrive, requires support from the major economies in the world. And at this point in time, this is unfortunately lacking. I'll stop here.
Thank you very much, Mr. Braga. I think we have now nearly 15 minutes for questions and answer. And I now call on Abdelilah to coordinate the Q&A session.
Thank you, Dr. Saeed. Participants, if you have any questions, please submit them through the Q&A tab. We have about 10 minutes of Q&A time with such a distinctive panelists of experts. We do have one question right now. The weakening of the multilateral trade organization like WTO was an ongoing issue before COVID-19 came on the world scene. How does this panel see that weakening to be impacted as a result of COVID-19, especially as trading within specific blocks could become the norm? Will the weakening be accelerated? If then, what would be the shape of the institution which could replace the WTO?
Abdelilah, if I could possibly weigh in on this, I think
Absolutely.
Our assessment at Center for International Governance Innovation is precisely that you need a very different kind of WTO to come out to regulate the future of trade. So in a sense, the pandemic, which has sidelined the WTO, has been basically, the WTO was designed to prevent import restrictions going up, but what we saw in the pandemic was export restrictions, which the WTO was not really well designed and provided lots of latitude for. So there's very little that it had to do other than provide transparency. But in terms of the long run, the pandemic is really tangential to this. It has probably accelerated the demise of the institutional framework of the post-1947 era, but it doesn't fundamentally change the need for new rules for a very different type of economy going forward.
Thank you, Dan. We also have Matthew who would like to weigh in on his view.
Thank you. Very quickly, so I'm based in Geneva and I follow the Joint Statement Initiative discussions, in particular what is happening on investment facilitation for development very closely. And I can speak to a little bit the role of that as part of the reform of the WTO in the sense of the role of plurilaterals going forward. And of course, there are a number of plurilaterals under discussion and they're moving at different speeds. At least when it comes to investment facilitation for development, there's a lot of support to concluding an agreement. And probably given the downflows of investment at present, economies realize the even more critical importance of making their investment climates and investment frameworks more friendly and easier, more predictable, more transparent, and so forth. So at least for this particular framework / agreement, I think there's even more potential interest in concluding something substantive, and potentially the COVID-19 crisis could have implications for some of the other joint statement initiative discussions, such as on e-commerce, which, given the growing role of the digital economy, these particular frameworks will have even more attention, being even more critical. So I think COVID-19 has some implications for these discussions and may in some senses slow them down or push them forward. But this is also part of the WTO, the new WTO, and what it brings to the table today. Thank you.
Thank you.
Abdullah, if I may, I would like to add some comments about the current situation. I used to be the World Bank representative of the WTO in the beginning of the Doha negotiations. And no doubt, the multilateral trade system has been under significant stress over the last 10 years or so, particularly after the breaking down of the negotiations that happened around 2008. There has been some progress in areas like the Trade Facilitation Agreement, but as Peter Draper very well illustrated, there are many systemic issues that need immediate attention. The first thing that I would emphasize is that all these new initiatives are welcome, but institution building is a very difficult process. And in this context, the WTO has, of course, a very important role and framework to move ahead, although has, of course, also many shortcomings. How to deal with those, Peter has addressed some of these issues. But going back to the question of the possibility of the world becoming much more organized around the spheres of influence, and this will happen not only in terms of trading goods, but also in the digital area. This is something that the COVID pandemic has created additional danger, to the extent that we have many accusations, unfounded accusations about and conspiracy theories about how the virus appear. And of course, the two largest economies in the world at this point in time are not seeing eye to eye, be it in terms of institutional reform, be it in terms of how to move forward. So my big fear at this point in time is that we are going to have a new type of cold trade war that will inevitably have significant implications, not only for traditional trading goods, but also for the evolution of the digital economy. So I just want to mention this.
Thank you, Carlos.
Come in, Abdullah?
Absolutely, Yuri.
Yeah, just very briefly, first of all, I agree with what Carlos just said and others. There is an overlay. There is an overlay of issues which need to be resolved, and at the base is the tensions in the WTO that are long-standing, that Carlos has illustrated and others, Peter. Then on top of that, we have the Trump uniqueness, the fundamentally protectionist and nationalist government in the world's largest economy. And then overlaid on that more recently is the China-US, the accentuation of the China-US rivalry. And on top of that, you have the COVID crisis, which has sort of accentuated many of these difficulties, particularly between China and the US. So there may be isolated areas of cooperation on small issues here and there, but we're not going to be able to move forward in the current context in a significant way. But history tells us that this combination of crisis can, in the end, lead to major alternative paths, and the turning point may come with the U.S. election, not immediately because of the China-U.S. tensions are fundamental, but over time with a new president and somebody who Joe Biden is multilaterally oriented, whatever he might be writing in the pre-election period. That's his history. Then a new US president combined with this addition of crisis, multi-layered crisis that are built up over the years could potentially lead to a situation where the United States changes course. And then a lot of people around the world, in the European Union, in Beijing, in Japan, et cetera, will be ready to consider completely new thinking and a step forward. That's one scenario. The terrible scenario would be the re-election of President Trump, But even if Biden is elected, then there is also a downside scenario there, because how strong will he be? How able will he be to steer the current US consensus against China? And many skeptics here in this country. So that's our best hope, is election of Biden, and then following that, Biden being able to provide leadership to the system. In that case, I think we could see big changes occurring, not necessarily in 2021, but 2022, 2023. That's a possible scenario. The other two scenarios are actually very dire.
Thank you, Yuri. We have one more question. So we don't go over time.